I'm also going to make this available on YouTube as well. I'm going to release this on YouTube as well for anyone that don't get a chance to catch it tonight. So I'm going to post on YouTube. So all my YouTubers that's out there, when you get a chance to see this, make sure you're subscribed, and then make sure you leave a comment, leave something down in the description. No, in the comment section, if you have any questions or if you have any thoughts or feedback, I'm happy to hear it all. All right. So with that being said, let's get going. All right. So when it comes to the option chain, all right, there are a couple of things you need to understand. You need to understand calls, puts. That's the main thing you got to understand, right? Majority of you guys know what that is, but for those that don't, I'm going to give you a quick little synapse, a quick little overview of it, right? So what is a call and what is a put? All right, and then how do you get into a call? How do you get into put? What determines it? And then how do you profit off of it, right? So when you have calls is when you think that stock is going to go up, right? Calls is when you think the stock is going to go up. So with a call, you have the right, but you don't have the obligation to purchase that stock at a specific price within a time period. Right. So you have the right, but not the obligation. That means with the option contract, you have the option to purchase those contracts where you turn it into actual shares where you'll be able to exercise it. So you have the right for that, but you don't have to do it. So that's what it means in terms of the obligation. Right. And you would get a call option when you think that said stock is going to go up. So say if we're looking at Apple and Apple is at $150, right? And you think Apple is going to go up. So therefore, because you think Apple is going to go up, you would buy calls because you think the price is going to go up. And as the price of Apple goes up, you would make money. For put options, that's when you think the stock price is going to go down. So for the put option, you have the right, but you have the right, right, but not the obligation to sell that stock at a specific price within a time period, right? And that's a put option. And then you make profit as the stock goes down. So going back to Apple, Apple is at $150 and you think Apple is going to go down to $145. So therefore, you would purchase a put option. And as the price of Apple comes down to 145, you would make a profit. So when the stock goes up, you make a profit with calls. When the stock goes down, you make a profit with puts, right? And then let me show you. Let's pull up. I'm gonna share my screen, share the chart, just so you can just see. Let me share this. Can you guys see the options chain? Type in yes if you can see the options chain. All right, awesome. All right, so let's go to Apple. All right, so this is Apple's option chain. This is the TD Ameritrade Thinkorswim platform, by the way, guys. So this is the TD Ameritrade Thinkorswim platform. If you're in the US, this is what I would recommend to use, TD Ameritrade Thinkorswim platform. So what we have right now, we have Apple. This is Apple's option chain. So I'm going to get into the expiration date. I'm going to break that down for you as well. So I'm just going to show you for calls or for puts. So calls would be on the left side. Calls would be on the left side. If you're using the TD Ameritrade platform, your calls are going to be on the left side. Same thing as well on your phone. So on the desktop, same thing. On your phone, same thing. Calls are going to be on your left side. Your puts are going to be on the right side. Calls, puts, right? And then I want to pull up the chart now just so you kind of see. All right, so this is Apple. Let's just keep for one. All right, so this is Apple. All right, so Say if I was looking at Apple, right? And as I'm looking at Apple, I'm debating whether to do calls or puts. And without going too far in depth, so you're not getting lost, and keep it as very simple as possible. And then when I do another video, I'll go more in depth in terms of like charting and stuff like that. So for Apple, say if I wanted to get into some calls, right? What I would look for, hey, Apple is currently at $172. Being that Apple's at $172, right? I would want to enter possibly over here or possibly over here, all right? Depending on the resistance, right? So what I would look to do, I would look to target probably 174, 175, which would be known as your strike price. And I'm going to also show you that as well. So for Apple, being that it's at $173 and I think it's going to go to $175, what I would do, I would purchase call. And as the price of Apple goes up, I will make a profit. And then say if I wanted to go into some puts, mind Apple's currently at $172.45. Say if I'm like, okay, I'm going to wait for Apple to cross the $171.67, or I can wait for this support level for Apple to break $171, and I want to target $169.99. So therefore, I would get into Apple to get into some puts. And as Apple goes down, I make a profit. Right? So calls, make a profit when it goes up. Puts, you make a profit when it goes down. Yeah, let's go back to this. All right. So the next thing, when evaluating whether to get in calls or puts, right, what you should be looking at, your strike price. Your strike price, that is going to be the most important determining factor in regards to the value of that contract, right? So the strike price is also known as the exercise price, which is the agreed upon price. It's the agreed upon price where you can purchase or you can sell the stock if you choose to exercise your contract. Right? So let me say it again. The strike price is also known as your exercise price. So when you exercise something, you're just turning it into shares. Remember, when it comes to option contracts, right, you have the right, but not the obligation. So therefore, you can turn it into shares if you choose to do so. All right, you can choose to buy it or you can choose to sell it for calls or for puts, but you don't have to. Primarily, when I trade options, I look to take a profit, right? Or I close it, whether it's for a loss or profit, I close it, right? If you are in the money, you can exercise your contract. So for your strike price, that's known as your exercise price. So say for calls, right? For calls, like I was showing you with Apple, what you want to do when you're picking your strike price, you want it to be something that's realistic. All right. You want it to be something that's realistic and something that's doable. I always get asked, hey, does it need to be in the money? Does it need to be out of the money? And then my answer is always, you want to get the contract that has high volume and that is affordable to you and that is within a realistic price that it can be reached. So therefore, you'll have the option if you want to exercise the contract, right? Because say if you do choose to get it in the money, when you're getting it in the money, you're normally paying a higher price point, right? You're normally paying a higher price point. So what you want to do, you want to get something that's a little bit affordable, and you can always buy more contracts as well. I'm gonna share this. Let me pull this. Right. So right here, back to Apple, right? So Apple was at $172. So say if I was looking at to get into some Apple contracts, Apple was at $172. And then, and I think the Apple will go up. So therefore, $172, something that is reasonable, $175, right? Once you start to get, right? Once you start to get in the money over here, right? This is your strike price, by the way, guys. The middle right here, this is the strike price. And for those that just got on now, the left side of your calls, the right side of your puts. The middle, this is your strike price. So, and then for this from here, this is in the money. Use the blue, we're in the money, right? So for Apple, it's at $172, right? It's at $172. So therefore, I would like to get into some calls. Being that I would like to get in some calls, if you look at the volume, decent volume here, really good volume, 31,000. And then volume, all it is the amount of contracts that's being exchanged between a buyer and a seller. So in order for you to, in order for every buyer, there needs to be a seller. And for every seller, there needs to be a buyer. So these are your contracts. Right. Apple's at 172. So if I was looking to get an Apple, I would be looking at the $175 contracts. Why? Because that's good volume here, and it's something that's reasonable, right? And it's something that's reasonable. You can also look to get this one as well, right? However, you're paying a higher premium for it. Most of the time, Apple is a great stock to trade because it has high volume automatically. But most stocks, when you're in the money contracts, the spreads are very far apart, which is the ask and the bid price. The ask and the bid price. I'm also going to go over that as well. Right, I'm going to break down the whole option chain, everything for you. All right. So I would be looking at the $175 because this is something that's very doable. It's something that's attainable. It's not too far. It's not anything where it's unreasonable, right? And you're making profit as it goes up there. You'll have a higher probability, right? So, and you don't have to pay an arm and a leg. Because say if you only have like $100, if you only have a small account, right? You can't afford to spend a lot, right? So, or if you have a smaller account, if you try to get in the money contracts, you're not going to be able to afford it. If you have $100 or $200, all right, why do that when you can get this and just get 2 or 3 more contracts? It's the same thing. And if you look at it, the spreads are good. The ask and the bid, the spread is great. It's only a cent apart. Same thing over here. So therefore, you're fine. And if you look at the volume, 68,000 in volume. So you're still good, right? Somebody just wrote a comment. This is powerful. Thanks. You're welcome. Totally reality. So, right. So that is your strike price. So when it comes to the strike price, but for calls, when the stock price is above the strike price, it is considered in the money. So for calls, when the stock price is above the strike price, it is in the money. And then for puts, when the stock price is below the strike price, it is in the money. And when it is in the money, you'll have the option to exercise those contracts. And like I said before, when you're exercising your contract, that means, right, you're either purchasing it or selling it because you have the right, but not the obligation to buy or sell that contract at a specific price. So therefore, you'll have the option to exercise your contract, right? So now, for out of the money, all it is just you're flipping it. So therefore, if the stock price for call options, right? If the stock price is below the strike price, you are out of the money. So Apple is at $112, right? Apple is at $112. So for calls, think of Apple, right? Think of the strike price being above the stock price being below the strike price or the strike and stock. They keep twisting the words. But yeah, so let's see. Somebody wrote a question. Do premiums move higher if you buy contracts in the money as opposed to buying out of the money? It's all based on volume. That's the biggest things. Yes, in some cases, but here's the thing, right? You can get an in the money contract, but the problem you may run into, Apple is a great stock where you don't have this issue, but with a lot of stocks, the in the money contracts, because they cost a lot more, the spreads, the ask and the bid price are further apart. The spreads are further apart. So the ask bid. So the reason why that's important, because say if this right here at 73 cents, which is $73, because one option contract equals 100 shares. So $73, right? The bid could be 65 cents. That means $65. And you want it to be tight. So that means if whatever this price is, as soon as you purchase it, it goes down to that price. Most cases, majority of the cases, if you don't trade a stock that has high volume, you're going to end up paying a lot more and you're going to start the trade down further apart. So that means you might start 5 or 10% down versus finding a contract that has tight spreads. All right, so let's go Boeing. I'm just going to show you. Just show you some spread differences here, right? So Boeing is a popular stock, all right? Most people know Boeing. However, doesn't trade with a lot of volume, right? So if you notice, the spread right here is a 5-cent spread difference. This is an 8-cent spread difference. That means whatever you purchase the contract at this price, as soon as you purchase it, it goes down to this price. As soon as you purchase it, it goes down to this price. So that's why you want to focus more on finding good quality contracts that have high volume. Because if you find a good setup, if the stock is moving in a direction you want it to move, it's still going to move. You're still going to make money. I've never had an issue with a stock where I found a good contract, whether it was in the money or out of the money, where it wasn't moving. If it was within a reasonable strike price and not something that is too far-fetched, it's still going to move because it has high volume. So focus more on the volume and then focus on a realistic number. All right. Hold on. All right, next, let's see, what's the other question? Can you not set a limit order to pay less? I'm gonna go over limit order. I'm gonna go over limit order, and it's on one of the slides. So save your question. I'm gonna go over that one as well. All right. So let's go into the next one. All right. So the next thing we have is expiration date. All right. And then any other questions you guys just type it in. I'll try to knock it out as well at the end as well. All right. Because I don't want to get off topic or get people confused or lost, but you can still type your questions in. And at the end, I'll try to go through all of them. All right. So the expiration date, that's the other thing you have to consider, right? So before you can pick out your contracts, right? So before you can pick out your contract, the first thing you got to actually look at and pick out is the expiration date. So when it comes to day trading, right? When it comes to day trading, for your expiration date, you want it again to be something that's reasonable, just like with your strike price. If you're looking to get in and out of a trade within the same day, it makes no sense to look to get a options contract that expires in a year or 2 years. Right? You want something that's reasonable. You're in a day trade, so you want to look at the weeklies, right? So what is the expiration date? So the expiration date, that's the last day that the contract is valid. That's the last day that the contract is valid. On or before that day, you'll have 3 options. Option number 1, you can either close for a profit or for a loss on your contract. That's option number 1. Option number 2, you can exercise your contracts if you are in the money, just like we're going over. That's option number 2. You can exercise your contracts if you are in the money. Option number 3, you can let your contract expire. And depending on your broker, if you let your contract expire, if you are in the money, it will exercise it for you. And if you are losing that trade, your contract will expire worthless. That means it will go to 0. Right? You never want it to go to 0. You never want to have your contract expire worthless. Right? That means you're just giving away money. Right? And I'm also going to go over the stop losses and your risk management as well. So I'll explain that a little bit more further. So with expiration date, your last day that the contract is valid, right? So I'm going to, let's go back to the option chain so you can see again. All right, so we're back in the option chain now, right? So we're back at Apple. So the first thing you got to pick out when it comes to getting your contract is the expiration date. And like I was saying, for day trades, right? For day trade, let's see. So for day trade, right, you want to look at weeklies. That means you want to look at the Friday expirations. Contracts expire every Friday, with the exception of your ETFs, those index funds, the QQQ, the SPY, QQQ, right? So they have 1 day, 0 days to expiration. So they'll expire on the same day, which is SPY. So you'll see SPY option chain will be a lot bigger because they have 0 days to expiration, right? But all the stocks, Fridays primarily is when, barring if it's not a holiday, that's when every contract expire, right? On weeklies, Fridays. So for day trading, you want to look at Friday's expirations, right? There's a couple of things you want to take in consideration when looking at Friday's expirations as well, right? So for day trading, for those that don't know, day trading is when you get into the trade when the time that the market opened, 9:30 Eastern Standard Time, and you get out of the trade before the market closes at 4 p.m. Eastern Standard Time. That's considered day trading, right? So for day trading, you want to look at the weeklies. And the reason why you want to look at the weeklies, because those contracts, those option contracts have the highest volume. The closer you are to the expiration, the higher you'll see the volumes are, the faster those contracts are moving. Versus if you go further out, it has less volume, and less volume means you're going to be moving a lot slower, right? Less volume, a lot slower. And if you're looking for day trading, right? If you're looking to get in a trade and get out within the same, it doesn't make any sense for you to go 2025 expiration or 2024 expiration. So that stock is gonna have this, it's gonna have to like overachieve, and it's still it's unless it just shot to the moon and we have an AMC situation, GameStop situation, because it has a very long ways to go, right? So I'm going to show you the difference. So this is the May 19th contracts. All right. If you take a look at the volume, right? Mind you, guys, the market is closed now. So it would be trading with a lot more volume. This is where it was closed on Friday. All right. So now let's go towards these contracts. All right. So this is the 2025. If you notice, there's less volume. The further out you go, the lower the volume. The further out you go, the lower the volume. And then the more costly that it is because there's lower volume. So this is the December 19th, 2025, right? Barely any volume, right? So, and this was May 19th. You have a lot of volume. That's this upcoming Friday's expiration. All right. So therefore, if you look at these contracts, these are very favorable contracts. Say if you go, let's go out to January 2024. Less volume here again, right? Less volume here again. And also you will notice the spreads, the further out you go, the lower the volume, the further apart the spreads are. So if you notice with Apple now, we were 1 or 2 cents apart. Now you're looking at 8 cents. You're looking at 8 cents. You're looking at 10 cents apart versus May 19th. You got 1 cent spread difference, 1 cent spread difference, right? And then as you go up, right? As you go over here, costs a lot more. You see the spreads get further apart. But the volume, the ones with the high volume, you notice 1 or 2 cents apart. And like I was saying before, you want to trade stocks, you want to get contracts that have the highest volume because you want tight spreads. Ideally, I like to trade contracts. I like to buy contracts that are about 1 to 5 cents apart, right? About 1 to 5 cents apart, because I don't want to start a trade down 10, 15% automatically as soon as I enter the trade. That means the stock is going to have to outperform. So I like my spreads to be tighter. Can you get a little further? Yes, you can. Right? You can. However, you better know that that stock has a good room to run. And if you plan on holding it, for a little bit longer, then yeah. But again, I like high probability setups. That includes good contracts that are part of the setup. Ideally, I like to be in a trade within 5 to 10 minutes max. So anytime that I'm in a trade, right, 5 to 10 minutes max. And if for any reason I'm in a trade a little bit longer, that's because there are less volume, right? And let me show you real quickly just so you can see what I'm talking about. All right, so I'm just going to show you. All right, so this is my Discord server right here. All right, so I'm just gonna show you how long. Look at the time from this yesterday, Friday. Right, so I got into 3 trades. If you look at the time, 10:57, 11:02, 10:57, 11:02. That's 5 minutes. All right, 10:30, 10:37. That's 7 minutes. 10:01, 10:09. That's 9 minutes. This is what I'm talking about. So when I look for these contracts, I look for the contracts that have high volume. These are the contracts that are moving. Being that they're moving, therefore you don't have to stay in the longer you stay in a trade, the more at risk you are of losing that trade, because options contracts are a depreciating asset. That means they lose value. The closer you are to the expiration date, the more value you lose in your contracts. So it makes sense if you can get in and out of these trades, you'd be fine, right? And then also there's swing trading, which is, for those that don't know, that's if you hold the stock overnight, that would be considered swing trading. That means if you were to get this, say if today was Friday, say if today was Thursday, right? And then you got your contracts, you didn't close out on Thursday, you hold it for Friday, that's considered swing trading. So then let's go back. I'm going to share. So now the next thing we have is the options premium. All right. Next thing we have is the options premium. So for those that don't know what that is, your options premium is the current price, the current market price of those options contracts, right? Those are just the contract prices. Those are your premiums. And in your premiums, you'll have the ask and the bid. Right? You'll have the ask and the bid. And then, excuse me, the ask price, it is the lowest price that someone is willing to sell a share. And then your bid price is the highest price that someone is willing to pay for a share. So again, ask price is the lowest price someone is willing to sell a share. Bid price is the highest price that someone is willing to pay for a share. So when you're purchasing your contracts, you always want to get it at the ask price to get a better price for your contract. You don't want to get it at the bid. That means you're going to have to pay more for those contracts. All right. So that means you would be paying a lot more. So always remember, it's better for you to get it to buy it at the ask price instead of getting it at the bid price. Ask price, the lowest price someone is willing to sell a share. Bid is the highest price someone is willing to buy a share. All right. And then I'm going to share the Thinkorswim just so you can see. Right. So these are options premium. These are your options premium. This is made up of the ask, it's made up of the bid, and it's made up of the volume. And then the volume, right? The volume, that's the amount of contracts that's being exchanged. All right. So anytime somebody say one contract is being purchased, that's one more volume. It's not the amount of people that's buying those contracts. It's the amount of contracts that are being exchanged. All right. So it's very different. So I can buy 100 contract, 200 contract, that would be part of the volume, right? Regardless if it's just one person doing it, right? Regardless if it's just one person doing it. So your volume is the amount of contracts that are being exchanged, going back and forth between the buyer and the seller. All right. Any questions you guys have? I'll knock them out. I'll go over them at the end, guys. So you can type your questions in. I'll go over it at the end. All right. And then also for those that are watching on YouTube, once I release this, make sure you click on the subscribe button and then leave a comment. If you have any thoughts or questions, leave it down. All right. So let's go into the next one now. All right. So when purchasing, this is what I'm talking about. You want to come here. You want to buy it at the ask price. You don't want to get it at the bid. So when you're looking on your Thinkorswim platform or your TD Ameritrade, this side is always gonna show that it's higher, right? Nothing for you. You're not gonna be paying more, right? You're not gonna be paying more. So this is what somebody, yeah. So you just want to focus on the ask price, right? You want to focus on your ask price, right? So something, the next thing, let me share it. All right, I'm gonna show you. All right, I'm gonna show you how to read your contracts now. All right, so we're gonna look at some calls and we're looking at some puts. So right here we have some calls. Right, so this was a put. This was a put right here. All right, and we're just gonna go over. We're gonna read it just based on everything we were just talking about, so you can see and understand. Let's double check. See, all right. All right, so right here we have AMD. All right, AMD. This is the stock that's being traded, the instrument. This is your expiration date, May 12th. This right here, $96. This is your strike price. Remember, strike price is your exercise price. And then this is a put. Remember, a put is when you think the stock is going to go down. The stock price is going to go down. And you'll make a profit as the stock price goes down. This is your premium, the contract price right here, $1.13. Remember, one option contract equals 100 shares. So you have to multiply that by 100. And when you multiply it by 100, that will give you your true cost of that contract. So $113 is what you would be paying for those contracts. So this is AMD. This is May 12th expiration, $96 put. So I was purchasing AMD May 12th, $96 put at $113, right? And this right here is also another put. Amazon, this is the instrument. I was purchasing Amazon May 12th, $112 puts at $122. So that means $112 is my strike price, but I'm betting for it to go down. And then this is the cost that I'm paying for it. Right here, same thing. So I got an AMD 2 times, and that's yet on Friday. Right, 2 times, made profit on both of them. So right here, $94. That's how much I spent on them. Right, $94. So when I originally brought it, it was at 94 cents, $94. All right, so let's show you. It was at $94. All right, as you can see, $1.10, and I ultimately closed out at 13%. Right here, and also it was in the money. The ITM, that means in the money. Remember, for puts, if the stock price is lower than the strike price, all right? So for puts, if your stock price is lower than the strike price, you'd be considered in the money. And for calls, if the stock price is higher than the strike price, then you're in the money. All right. And then also just real quickly for those that are on YouTube, I'll leave the link for access to my server. I'll leave the link for access to my server in the description. And then you guys will be able to watch all the other videos that I have. And these videos are all for free, just like I'm on here doing the webinar, all for free. So I have videos on technical analysis, different strategies that I use in the market, how to chart, how to enter these trades, your risk assessment, all that, teaching you all for free. All right. And then on top of that, we have the webinar, which is what I'm on right now. This is also for free. Right. I do webinar live. And then I also send out a free watch list every morning before the stock market opens. Every morning I send out a free watch list. All right. And then with all these things that I'm doing to teach you, to educate you, if that's still not enough, mind you, I'm teaching you how to fish. I'm not getting paid to do any of this for free, by the way. All right. This is me trying to teach you how to fish. So whether you sign up for my server or not, the info will still be here. I'm still going to wake up. I'm still going to trade. So my recommendation is use it to your advantage. Right. And then with all the info, the free info that I'm giving you, if that's still not enough, what I would recommend is set up a one-on-one coaching call. And then for the one-on-one coaching call, that one is 60 minutes. That one is not for free. It's 60 minutes via Zoom between me and you. And I'm answering whatever you don't understand, whatever you want to learn. We go into it just like I'm sharing my screen, breaking it down. Same thing. We go more in depth and help you with everything that you need. Right. And this is $110. And this is for 60 minutes via Zoom. Right. And it's very simple to set up. You just pick out the date and time, you book it in my calendar, right? And then boom, you pay for it, and then you get a Zoom calendar invite instantly in your receipt, right? And then if you want to get access to my alerts, this is where I literally hold your hands and make it as easy as possible. I do all of the work for you. You would have to upgrade because I'm already teaching you how to get everything for yourself. You would have to upgrade. And then when you click that link, it's going to bring you over here. When you get to this page, you'll have the monthly subscription, which is $39.95. I make sure to keep it at a small account friendly amount so everyone can have an opportunity to join the server, because there are servers that are charging $100, $200, $300, and then they're doing a lot less. So $39.95, very affordable, very doable. And then the yearly subscription, you're looking at $130 savings at $349.99. And then for those that are on tonight, if you want access to the server, I do have a coupon that's currently running. It probably, when I release this video, it won't still be out. But up until tomorrow, if you use the coupon code join now 10 off, you'll get 10% off the yearly or 10% off your first month on the monthly subscription. And the coupon code is join now 10 off. Just type it so you guys can see. So join now 10 off. And then you're looking at $130 already off this plus the 65. So you're looking at $165 savings. Right. And then once you, or also you can do a 7-day free trial as well. My winning percentage is 85%. The last 20 trades, I've won 17 out of 20 trades. Right. And then the last 50 trades, I've won 40 out of 50. And then the last 100 trades, I've won 81 out of 100. Right. And then any of our current premium members that's on here, you guys can attest to this. So shout out to you guys and congrats to you guys on all the wins that we get. Right. And I want to show you guys, for those that are watching, I'm just going to real quickly. So once you sign up, right, first thing you want to do, check your email. You're going to get 2 emails. The first is going to be the receipt. The second email is going to be the link to the server. The link to the server, you must accept and authorize the member for bot. And then once you get in, come to the info start here. I have simple guides to help you. I have videos, right? I have recommended brokers. Any questions that you have, a simple guide just teaching you how the server work. But let me give you another breakdown of how it works. So in the watch list, this is where I give you my game plan. This is why I let you know everything that I do going into the day before the market open. I let you know the stocks that I plan on trading for the day, with the exact prices that I plan on entering if the setup is there. I also let you know what I'm looking at, like the setups. I do a step-by-step analysis. I break down the charts so you can see everything for yourself, so you can evaluate if this setup is good for you to take. Because too many times, right, I know people get into trades where different servers and you don't know why you're getting into a trade. So if you lose or win, you just don't know. So what I try to do is make sure that I explain everything that I'm doing so you can understand for yourself, not only to be able to understand and make a judgment call for yourself, and you can assess if this setup is good for you, but also so you can learn over time. You can learn over time. I don't expect anyone to trade with me forever, right? But this is a skill that you can learn and you can use for as long as you can. With how the economy is right now, this is something you can utilize and make money, right? So use a step-by-step analysis. I'll let you know everything that I'm about to do. I explain to you why I'm getting into these trades. I show you the charts, give you the breakdowns, and then I let you know the contract prices in advance before I get into these trades, so you can be ready. As you can see here, where I had NVDA made $282.5 put, and I said, be ready if I send it. And then after that, I come in here, I send out the signal. And every signal that I send, I make sure that it's small account friendly. It's less than $130. I make sure that it is affordable for those that want to get into it. If you have a small account, you'll have that option. And if you want to purchase more, just buy more contracts, because I find the best contracts. So therefore, you guys can get into it, right? And which is what I was just showing you guys, how to look for contracts. And then while we're in the trade, I keep you posted with what's happening in the trade. So you should never be lost. You don't know what you should be doing with your contracts. I let you know what the contract price is at. I let you know when you should be taking profit, when you should be closing, whether it's win or loss. I'll let you know. So there should never be any reason where you don't know what you should be doing, or you should feel like, oh, you're just at loss. All right. So I'm just going to quickly scroll through and I'm going to get back to the PowerPoint and I'll do a quick count. So this was 1, this is 2, 3, this is 4. So it's the same thing. This is 4, this is 5, this is 6 wins. This is 1 loss right here, 6 out of 7. This is number 8, 9, 10. So we're at 9 out of 10. 11. So 9 out of 11 is 2 losses. I think I had another loss that day as well, too. Yep, this was it right here. So 9 out of 12, 3 losses. This is a win right here. Right here is another one. So we're at 14, right? So we're at 11 out of 14, 11 wins. Let's see, number 15. And also, you can see, as you guys see, the last 60 trades I've profited on 51 out of 60 trades with an 85% winning rate. Boom, as you guys can see, right? So this would be 15. All right, 16. I had won 4 trades that day. 17, 18, 19, and this is 20. So 17 out of 20, I can keep going. But I don't want to spend too much time just going back and forth so you guys can see. If you want to see it, just don't forget, just click the link. I'll leave it in the description, and then you'll have access here. And all you want to do is click upgrade and click on that, and it'll bring you to this page. And then you can do a 7-day free trial. You can see it all for yourself. You can also do the monthly subscription or the yearly subscription. And also you can run through the testimonials. I've been helping people, thousands and thousands of people, make money in the stock market going back since 2021. I've had this server since 2021. So you can scroll through and you'll see it, be able to see everything all for yourself. All right. And you can check the timestamps. All right. This is November 22nd, 2021. My first ever call because of the server. Thanks. All right. My man made 111%. All right. So with that being said, I am going to go back to the PowerPoint for you guys. All right. All right. So the next thing we have market orders and limit orders. Market orders and limit orders. Matter of fact, let me answer a couple questions real quickly. Just all right. You'll go. We know we are in the market orders and limit orders. Yes. Just scrolling up, guys, to get some of your questions. Can you set a limit order to pay less? I get what you're trying to do. Yes. So pretty much the limit order, well, which is we're on that right now as well. So which is perfect. So limit order, yes, it sets a maximum or minimum that you are willing to buy that contract. All right. So it pretty much will get you like the best price with so say if you want to so if say if a contract is currently at 85 cents at the limit, right? And you want to get into that contract, you can set your limit at 85 cents, right? So it will not fill unless it's at 85 cents or better. So yes, you can set that, right? You can set that because automatically you'll have the option when you're getting ready to buy it, it'll be market or limit, right? And in market order, what it is, it allows you to buy it allows you to buy your contract as quickly as possible because you're getting at the market price. So you'll get an instant fill versus the limit order. You might not get that fill. So say if the stock, right? So say if you want to get into some call options, right? You want to get into some call options for Apple, $175 call, and Apple's contract price is at $1, which is $100. And then you set your limit at $1 and Apple starts taking off and that contract goes to 105. You're not going to be able to get in unless it comes back down to that price. So you will have to keep adjusting your limit. However, with the market order, it will get you instant fill at whatever the market, that contract price is at currently. All right. So I hope that answered your question. Can't seem to see the percent on the profit or loss on my Think or Swim screen. You should be, well, right now the market is closed. But if you were to pull it up, if you're into some, if say if you have your phone, right, you pull up your phone, as soon as you tap on that contract, you should be able to see it. Right? As soon as you tap in that contract, you should be able to see it. It should tell you what your contract price is at automatically right there. And then the other way you can see it is let's see, depending on if you have, let's see, oh, because you said the Thinkorswim platform, right? So on the Thinkorswim platform, because I know personally, I like using the phone. I like using the phone when I get into the trade versus buying it on the desktop. I just feel like the phone is a lot easier and quicker. So, but I'll monitor the contracts and everything on my desktop, but I'll enter it on my phone. So, like, I have like two phones, like, so like one will do one and one, and I'll just be monitoring or like just messaging you guys in the server as I'm entering the trades. But you should be able, once you tap on that contract, you should be able to see it. Let's see, what's the next question? The premium has always scared me away from options. I never wanted to lose all my profit to the premium. Is there a way we can minimize our losses from the premium where we can realize more of a gain? Yes, I'm actually going to go over a risk assessment. Robert, I'm going to go over that. Yeah, I'm going to go over that as well. I think that should be like the next slide. All right, so that was market and limit. So remember, if you want to get into the trade as soon as possible, instantly, you would do a market order. If you're looking to get the best price for your contract, you would do a limit order, right? And then you'd have to decide, hey, are you looking to get into that trade instantly, or can you wait for that to get the best price for it? Once you decide that, then you should be fine. Depending on, say, if a stock is moving really fast, your best bet is to get market order. If it's moving a little bit slower, then you should be fine with the limit. All right, so let's see. Was the other question? Next question. Let's see. Hmm. Typical win amount on one contract, it all varies. So, like, say if you buy a contract at $100 and it goes up 20%, all right, you make 20% out of that $100. Right, that's was $20. So it all varies. It all varies. The more money you have, um, the more you'll make. All right. So the more money you trade with, the more opportunities you'll have to make more. I believe think a swim limit how many trades you can make. How can I get where do I? So, Robert, with any broker that you have, if you're using so the question that for the viewers that can't see, so the question he's asking is he thinks that Think a Swim limits how many trades he can make, and he wants to get into more trades. So, if your account size is less than $25,000, you have to have a cash account. So yes, depending on the broker that you have, well, not depending, all brokers, right? All brokers, if you're trading with less than $25,000 in your account and you don't have a cash account, you're only limited to 3 day trades in a 5 business day period. If not, you're going to get flagged as a pattern day trader. So what I would recommend is to switch your account from margin to cash account. So therefore you can get in as many trades as you want. And the only thing where you'd have to worry about is just waiting for the cash to settle. What that means is you got to wait 24 hours. So whatever you use that same day, you can't reuse it. So say if you have $1,000 account and you use $300 in the morning, you'll have $700 to use for the rest of the day. You can't reuse that $300. Right. So cash account. All right, so I'm going to get back in and I'll finish some of the questions in a little bit. All right, so stop limit order. All right, so there are a lot of people where well, majority of, if not everyone, has a job or busy or have life things that happen. So you might not be able to monitor what's happening while you're in the trade. So tools that you can use are your stop limit orders, your trail stops, right? Those will protect you from your contract expiring worthless or from your contracts going bad on you and will take profit for you. So, for example, the stop limit order, right? So, the stop limit order has a stop loss for you and it has a take profit for you. So, say if you think Apple is going to go up, right? And you think Apple is going to go up to whatever a price is, and you want to make at least 10 or 20% profit on it. So, what you would do, you would put the contract price 20% higher than what it currently is at. So say if the contract is currently at $1, which is $100, so your take profit, your limit price would be $1.20. And then say if you want to have a 10% stop loss, being that Apple is at $1, $100, your stop loss would be 90 cents. So minus 10. That would be your stop. So your stop limit is going to take profit at $1.20. And if the stock were to come down to 90 cents, down 10%, it will automatically close out your contract. So this guarantees you autofill for either direction. And this right here is a great tool that you can use to protect yourself in the event that you cannot monitor. You cannot monitor the trade as you're in it. So now for trail stop, right? So say if you get into the trade, right? You do a stop limit order, and then you notice, you see that you're in profit. The next thing would be I would recommend, or not recommend, what you need to do is cancel and edit that from stop limit order to a trailing stop. A trailing stop guarantees it locks in profit for you, right? So that means you don't lose anything. So back to the Apple, right? Apple, you got in at $1. Contract price is at $1. You got in, and Apple is currently at $1.20. It's at 20%. So what you would do is you can say, hey, I want to automatically get out with Apple. If all else fails, if it flips on me, I can't monitor it. I'm going to put it at a trail stop of 10 or 15%. So say, let's go with 15%, right? Being that Apple is at $1.20, you'd put minus 5 cents. So if Apple were to flip and come down, it would automatically fill your contract at $1.15. That means you would automatically walk out with profits. And trail stop is only for profits. So you cannot put a trail stop at a lower contract price that you purchased it. So if you purchased the contract at $1, your trail stop has to be above $1 because it guarantees you profit. It guarantees you profit. So if you're green, right? A rule of thumb for me, anytime that I'm green, starting 10%, I'm normally alerting our members, right, to start putting a trail stop. Start putting a trail stop, figure out what they want to do with their contract just to protect yourself, because the last thing that you want is to lose money because you're holding on too long and you didn't have anything to hold to protect yourself. I'm going to show you what I mean by that. All right, so let's go to the bottom. All right, so if you notice right here, this was with NVDA. This was 33% right here, right? NVDA with 33%. Contracts were moving. And right here, I say, leave a trail stop. Leave a trail stop, right? So it's either you're going to take profit, or if you're going to hold it, you leave a trail stop. So as I'm getting ready to take profit, the contract was at 33%. I was up 33%. And right when I'm about to close, it came down to 26%, right? So this is why it's important to have a trail stop, right? If you're going to hold the contract, and these contracts were moving very fast, it was 950, and in 5 minutes, 33%. So literally it was flying. So all of this within the 1 minute it took off, right? So this is why it's important to have a trail stop. And when you're leaving a trail stop, things to consider. It's going to say day, or it's going to say GTC. Day, that means it's valid until the end of the day. GTC, that means it's valid It's good to until you cancel it. So that means if you set a stop limit order, make sure you put it on GTC good to cancel. Say if for whatever reason you were to get occupied at work, or you can't, you're focused on something else, or you didn't get a chance to close it before the market before the market closes, you want to make sure that's at GTC to protect yourself. It's good until you cancel it versus that day. So if it's on that day, automatically is going to get canceled once the market closes. Automatically is going to get canceled once the market closes. So therefore, whatever happens overnight, what happens the next day, you you might be screwed. You might be screwed, right? So you want to make sure you put it on GTC versus day. All right, so let's get back. Let me reshare this. I'm going to show you. All right, so give you some examples. So this is Apple, right? So this is what I'm talking about right here, right? So when you're going to Apple, right, first thing you're going to see, this is Apple, single buy, right? And then the contract quantity, you can choose whatever amount you want. The market is closed right now, so it doesn't matter, all right? So say if this is one contract, right? And this Apple strike price, this is May 19th, $172.5 call right here at $1.82. That means at $182, you do not lose more than you put in. That means you do not lose more than $182 if you were to get one contract. So this is what I'm talking about when it comes to limit, market, right? Stop that means if you're getting into the trade, you want to have a stop loss, right? But my thing is, it makes no sense for you just to go and just put a stop. It's better for you to have a stop limit versus just one without the other, right? So if you want to have a stop, make sure you have a stop limit. Make sure you have a stop limit for both ways, not just one, just to protect yourself. All right. Make sure you have both. And then this is what I'm talking about, day or GTC. Right here, day or GTC. That means the contract, right? With the stop limit or the trail stop is good for the day versus good until it's canceled. All right, so let's go back into this. All right, and then so now risk assessment, because I know there was a couple questions on that, right? So like I was saying earlier, that one option contract equals 100 shares. And that's because, all right, so one contract equals 100 shares. Remember, you have the option, but not the obligation to exercise your contracts to buy or sell that stock. So that's where that comes in. All right, that's where that comes in. So for risk assessment, for those that are trying to figure out what your stop loss should be, how much you should be buying for these, when you get into a trade, think of it this way. This is something that I use for myself, and I would recommend anyone you can use the same strategy, right? Depending on what your account size is. So say if you have a big account, right, over 25K to 100K or more, right, you can use a 5%. Say if you have a smaller account, so you can use 5 to 10%, or even if you go smaller, say for example, say if you have a account size of $1,000, right? If your small account, your account is 1,000 less. So what you want to use about 10 to 15% of that portfolio balance. So that means 10 to 15% of that $1,000 you're using for every trade. 10 to 15%. So in the event that the trade does not work out, you do not lose more than that. So 10 to 15% of $1,000, you're looking at $100 to $150 per trade. Mind you, every trade that I send out is no more than $130. So you can get into every trade. You can get into every trade. Right? So at 10 to 15%, you're risking $100 to $150. So now you're going to have a stop loss. Your stop loss, what I would recommend, use 15 to 20%. Or if you are a little bit more open to taking a little bit more risk, I would say 20 to 25. Keep it below 25, right? 20, 25. And if you really want to turn it up. Don't go any more higher than 30%. The other way to do it is if you understand the price action, all right? If you understand the price action, then you can set stop losses based on your support and resistance. And that's a whole different ball game. But majority of people don't understand the price action, don't understand how to chart. So therefore, you want to stay with a certain percentage. And every trade that I get into, for those that follow me or for those that are in my server, I let you know what the sell prices are. So that means based on, I'm going to show you what I'm talking about. Based on that, the price action, I know my, so before I get into any trade, I know my entries and I know my exit, whether it's for profit or for loss. And what I mean by that, I'm going to show you. All right. So let's look for a trade that I lost. I'm just going to All right. So this trade right here, this was NVDA, right? I lost on NVDA right here. And then with NVDA, it was a 14% loss, right? 14% loss, kept it under 15%. However, my sell was $286.87, right? And then going into the trade, I already know what my take profit was going to be, and I knew what my stop loss was going to be. So when I sent out the signal, I was in profit. I was up, as you guys can see here, right? I was up, and then let's see, this was May 9th. Let's pull it up. What did I send those contracts at? May 9th, NVDA. Yep, so I sent the contract at 87 cents, right? 87 cents, the contract went up to 92 cents, from 87 to 92 cents, right? And then we had choppy price action. So that means a lot of flip-flop, a lot of up and down, right? And then I ended up getting stuck in the chop. So my sell was this price. And the way that I got that sell price was because I saw there was a resistance that was above it. And if it broke that resistance, it had like a gap to fill. It had a big candle it would have to reclaim. So therefore, right, the next path of resistance was far away. So to get from here to here, that would be a major big loss. So automatically I knew long as it stayed there, I would be fine. So I'm going to share the chart, just kind of give you a quick little example. Go to the chart. Right, so this is Apple. Let's go to NVDA. Right, so this is NVDA, right? So say if I wanted, I'm going to give you an example, right? So say if I wanted to just set a stop losses based on looking at this price action, right? And I'm like, okay, I want to get into some puts. I think NVIDIA has some room to run, right? I want to get into some puts. So what I would look to do, right? I want to get into some puts. If I get in, I would probably set my stop loss right around, I would say this price right here, 283.55, right? This would be right here, right? Or if I want to go a little further, I can go 283.99, right? And the reason why, because if you notice from here to here, he has some ways to go, right? If you look at the resistance, it has some ways to go. It has some ways to go. And then say if I wanted to get into some calls, I'm like, hey, I'm going to play the bounce off this 200-day moving average, right? I'm going to play this red line right here. This is the 200-day moving average. I'm going to play the bounce to get into some calls. I would have my stop right here because I know if it breaks this, it has some ways to go. If you notice right here, $180.49. And then look at the next path for resistance. Look at these candles, right? We'd have to retrace. Look at this. We'd have a long ways down. So therefore, automatically, I know, all right, boom, I gotta get out of this. I gotta get out of this. If not, then I'm gonna be stuck going down, right? So that's one way for you to understand the price action. That's how you can figure out your stop losses. But the other way, automatically, you want to have a certain percentage that you get into the trade. So like what I was saying earlier, 10 to 15% is your original risk. And then you would have a 20 to 30% stop loss max. So you went from risking 10 to 15% to now risking about 2 to 5%. So let me just break it down for you again, right? If you have a small account of $1,000, right? And you use 10% of that $1,000, which is $100 to get into a trade, that $100, you don't lose any more than that $100. However, you're going to have a stop loss 20 to 30%. 20 to 30%, that means $20 to $30. So you went from risking 10% to now risking 2 to 3%. So that keeps you protected. And you use that same percentage every time. And as your account size grows, you stay with that percentage, right? As your account size grows, you stay with that percentage. And then you can have a set price or set amount, not price, set amount for when your account get to, when you get to a certain size where, automatically, all right, I got to reset. So like something that I do to keep myself from ever over leveraging, from ever being greedy, every 2 weeks or every so often, right? Every 2 weeks or at the end of the month, what I would do is I will take the money, all my profits, I will transfer it over to my long-term investment. I will pay bills or just move it over and then restart at a set amount. So therefore, I don't get greedy. So therefore, I don't over leverage. So I keep or pretty much stay humble in some ways because the market will humble you. The market will humble you. All right, so let's go. Let's switch. Let me share again. Yeah, and now we're getting to some questions. Let's see. All right. So if you guys have any questions, type in your questions. I'm going to answer some questions, and then we can, let's see, scroll up. All right. So Robert, I hope I had answered that question for you when you said about the premium scaring you, about protecting your capital. So I'd recommend using the risk assessment strategy that I just said. That should help you, right? And then remember, um, when it comes to your premium, you want to find contracts, all right? Find contracts that are tight, all right? Because you don't want to find contracts that are far spread. So you don't want to say, hey, let me just get an in the money contract because it will most likely move faster. But if you're going to start the trade down 10 or 15%, it doesn't make any sense. That means you have a higher probability, a lower probability of winning that trade. So just you want to give yourself an opportunity, a chance to win that trade. Let's see. Next question. Why would I want to buy at the ask price if I want to sell the contract immediately? I will sell at a loss because of the bid price. No, so when you're buying it and when you're selling, it's two different things. When you're buying and selling, it's two different things. Two different things when you're buying and selling it, right? So when you're buying it, the ask and the bid, right? When you're buying at the ask price, you're getting the best price for that. That means you're getting a lower price for it. When you're selling it, you can sell it at the bid. Somebody, depending on how that stock is moving, you can sell it and switch it to the bid, right? Sell it and switch it to the bid, wherefore it's going to bump the price up. When you buy it, you buy it at the ask. You don't want to buy it at the bid. Buy it at the ask, not the bid. And then I think so. So you can understand. Look, if you're trying to sell it, you want to sell it immediately. That's different. Market and limit order. I think you're confusing the two. Market and limit order. That right here will get you instant fill. Market or limit order. But in terms of just the contract price, right? In terms of just the contract price, the bid price, that means the high is going to be the higher price. Right. So if you're selling it, you can certainly put it at the bid and see somebody will pay for it. Right. There's always somebody out there, but it may take a little bit longer. All right. You might not get that instant fill. Um, let's see. At what point would you recommend to set your stop loss? Antoinette, at what point would you recommend to set your stop loss the moment you get into the profit or set it before? Is there a trailing stop where you can set, etc.? So good question, Antoinette. So few things. You can set it before you get into the trade. All right. You can set it while you're in the trade. You have the option to do both. I'd say it might be easier to get into the trade and then edit it, because as soon as you get into the trade, you can instantly edit it. So the same way that you would go and sell it, all you would do, you'd go in there as if you're getting ready to sell your contract. All right, I'm gonna show you. Let's pull this up so you can see. Right, so this is NVDA, right? You see where NVDA says buy. So say if I bought one contract, right? And then as soon as I enter the trade, as soon as I want to enter the trade, I'm like, all right, I want to have a stop limit, right? Just to protect yourself, like you're saying. So what you would do as soon as you get in, now that you're in, all you would do, you'd go as if you would sell it, all right? You go as if you would sell it, but you're not actually selling it. You're just editing it. You're gonna set your stop limit, right? You're gonna put it right then and there. That's all you would be doing. That's all you would be doing, right? So you can edit it right after you get into it. That might actually be a little bit easier, because you'll be able to get a faster fill. This next, I'm scrolling down, guys. I'm scrolling down questions. Hold on. One, I think I answered that one about your stop loss. Let me know if you understand it. Garnell, how do I deposit funds from my bank to the Thinkorswim account? So, Garnell, the way that you would do that, you'd go into your TD Ameritrade. So log into TD Ameritrade. Remember, TD Ameritrade is the brokerage. Log into TD Ameritrade, and then I believe somewhere at the top, they'll give you the options, like your profile balances, and then you can fund your account. You can do direct. It's literally there. You'd have to go to TD Ameritrade and fund it through that. You can't fund it through Thinkorswim. Thinkorswim is more for the platform. TD Ameritrade is the brokerage. So you have to go through TD Ameritrade app to do that. Antoinette, can you go over the logic of the stop loss? If I buy 120 call, then my stop loss has to be what? 90 is right? No. So the logic of the stop loss is just to protect yourself, right? You can have a mental stop loss, you can have a hard stop loss. Is to protect yourself. You don't want to get into a trade and you don't know what your exit is, right? You want to be able to know your exit. Part of options trading is protecting your capital. In order to make money over time, you have to protect your capital, not let your account not blow your account. So therefore, the best thing to do is to always have a stop loss. We can't predict the market, but we can react to the market. You can have the perfect setup, but the market will do what it wants to do, right? There's no setup that's 100% because a report can come out, the Fed chairman can say something, the president can say something, and then the trade can go against you, or the volume can just drop. You may get a rug pull where the volume drops out of nowhere, and therefore the stock just moves sideways, right? And being that options contracts are a depreciating asset, as that stock moves sideways, those contracts are losing value. So therefore, it's burning, even though the price hasn't gone anywhere. But the longer that you stay in it, the price goes down. And then let's see, he said, so the stop loss, you can whatever based on your account size, based on your current financial situation, based on your risk tolerance, you can determine, hey, it's 15%. Are you okay with risking 15%? Can you afford to lose 15%? Can you afford to lose 20%? So you have to assess your current situation. What is the max you're willing to lose? Oh, or you're okay, losing on that specific trade, right? And then you normally want to have that if you don't know what your exit is going to be by looking at the price action, the chart. All right. That's why you don't want to have that, because say if you're at work, or say if you don't understand the chart, you don't understand the price action, you have to know when it goes out. You can't hope that it's going to bounce. You can't hope that, all right, I hope this is going to go work out well. No, you have to, hey, this is what it is. This is where it's headed. And this is where I say I would get out. This is where I'm out. You live to fight another day. So I hope that answered your question. And good question. Let's see. Maito, I'm sorry if I'm pronouncing your name wrong. So buying at the axe price, which is nope, you're buying at the axe price. The axe price is lower. The axe price when you buy is going to be lower. The bid price you're paying more. You're going to be paying more for the bid price. You're going to be paying more for the bid price. The axe price is the lowest price someone is willing to sell a share. So say if you were to click on bid, as soon as you click on bid, you're going to see the price. You're going to see the bid price up. You're going to see the bid price up higher than the axe price. So axe price, that's the lowest someone is willing. So therefore, that person, remember, options trading is exchange of contracts. So say if you're getting ready to buy a contract, right? And I have that contract and I'm selling you that contract, right? And then I put a bid on that contract at a high price and you buy it at the bid, that means you're accepting to buy at my bid versus the axe price. That's the price that you have set on it. So the bid price, you will see it change because the bid will go up, right? However, your axe price will continue to stay what you originally have your axe price at. So whatever the bid was, right? The bid can adjust, but the axe price where it's at, that's where you will stay at because that's what you're looking to get out of it. That's where you look. That's where you're looking to get in at that specific price or better. Let me know if that makes sense to you. If you understand. Let's see. Just to be clear, I can only, and just to be clear, Rodney, just to be clear, I can only lose the amount paid for the contract and no obligation if the stock bottoms out. Correct. So if you buy $100, right? If the contract costs $100 and you purchase that contract at $100, you purchase one contract, you cannot lose more than $100. You cannot lose more than $100, regardless if the stock goes down. Right, regardless if the stock goes down. Let me show you, right? I'm going to show you an example. I'm going to show you an example. So, right here, all right? So, this is NVDA, all right? If click on NVDA, it's at 33 cents, right? So, when you come here, when you hit confirm, it's going to tell you, right? How much. So, you see what it says here? Max loss is $33, all right? $33. And then max profit is infinite. All right, so you don't lose more than you put in. You do not lose more than you put in. I just realized again, it's about to be 9:30. I've been in here for some time. Whew. Time flies, guys. Next question. Mayadi, what I would work. I'm sorry if I'm pronouncing it wrong. I feel like I'm getting this wrong as well. All right, so when you click on the bid price, right? When you click on the bid price, all right. Matter of fact, let me flip it for you, right? So when you're buying your contract, right? The spread that tells you the spread difference. So that tells you as soon as you purchase your contract, what it goes down to. All right. It tells you what it goes down to. As soon as you purchase your contract, it tells you the spread difference. Right. It tells you the spread difference. As soon as you purchase your contract, that's what it goes down. It's going to go down to. But when you're trying to buy your contracts, all right. Oh, let me flip. Hold on, let me just pull this back up. So when you go for the bid, right, you're going to end up paying more. So I would say on Monday, while the market is open, I'll show because the market is closed right now, so you can see, right? So see, okay, I'm understanding you is the trailing. I'm understanding trailing stop. I'm just reading this trailing stop after getting into the profit. Well, let's change it. Just reading the question, guys. And for those that are on YouTube, Um, this is a live Zoom webinar. I'm not sure if you guys can see the chat. So they're asking questions. I'm just answering some questions. And then don't forget to subscribe. And don't forget to click the link that I'm going to leave below in the description so you can have access to the server and you can have access to these webinars, which are all for free. And then you can have access to get into my alerts. All right, let's see. Let's pull this up. All right, so let's see, go back to, so I'm going to share this with you. This is the NVDA 297. I'm going to pull it up, NVDA 297.5. So I'm going to share what I'm talking about. So my ID, so you can see exactly what I'm talking about. Hey, I'm going to share this. So, all right. So what you said, let's see, you have the two, oh, hold on. All right. So you have this contract up right here, right? So the $297.5 call, right, for NVDA, right? You have the axe and the bid. I'm going to show you exactly what I'm talking about right here. So we're going to go into the 297.5, right? 297, the axe price is at 69 cents, right? So if you click on the axe price, right, it shows you what the contract price can buy. And when you click on the bid price, it's going to show you that you are going to sell it. We are always buying, we're not selling. So if you click on the bid, you see how it turns red? All right. When you click on axe, we're buying the contracts. We're not selling the contracts. We're buying the contracts. All right. You see right here versus click on the bid. As soon as you click on it, boom. We're buying the contract. Always buy. We're buying the contract. That's why you're going to buy at the axe. Let's see if cash. Next question. Okay, I'm understanding you. Is the trailing stop after getting into the profit in the same area of think a swim to change it from stop? Yes. So great question. Something to remember, right? Before you can edit it, you want to make sure that you cancel and replace it. You want to make sure that you cancel and replace it. You don't want to put in a new order, right? And then while the other order is still working. So say if you have a stop limit on, right? You got into the trade, you bought it at market or limit, and while you're in the trade, right, you bought at market or limit. However, right, you want to make the adjustment to a trail stop, and you just go and put trail stop. It's not going to work because you already have one thing working. So you would have to cancel the stop limit and then cancel the stop limit and then add the trailing stop loss. No, the trailing stop, right? And then the trailing stop, it guarantees you profit. It always and it has to be above what you paid for your contract. So it guarantees you profit. So as soon as you in that trade, remember, but for any adjustments you make, you want to cancel and replace. All right. You don't want to have multiple working orders, then therefore nothing is going to happen because you have too many different things. So I hope that answered your question. I hope you understand. If not, just let me know. And then let's see, Rodney, if cash was not an issue, do you prefer trading stocks or options? It all depends. Personally, I would say options, unless you have like millions you're buying and selling with, because the profit that you're making from trading stocks is not much. So like say if Apple goes up from 172, right, it goes to $180, right? That's nothing really. All right. So think of it this way, right? If you were to just have one share of Apple, and if it goes up 172 to 178, you're only making $6 profit. So you'd have to have a crazy amount, like a really high amount to make enough. like hedge funds kind of money, right? Because that would limit your risk because you have so much more you're working with. But I would say with the options, right? If you have no issue, you'd make more with the option trading because the contracts, the values of it, right? So you don't have to wait. Think about it. The stock is not going to, for you to make, for the stock to go up 20%, you're making 20% from the entry price that you got, right? If you're buying and trying to trade it. And on top of that, here's the other kicker, right? You're going to get short-term capital tax gains because you're buying and you're trying to do this pretty much. It's like unless it's a big amount, unless it's a big amount, it's not it's not worth because it's going to be too small of a price difference to make much of a change. Say if the stock goes up on average, the S&P 500, it goes up 10 to 15% annually, right? 10 to 15% annual. So therefore, you're going to have to hold that stock at least a year just to get 10 to 15% from it if you're trying to trade it in terms of just like buying it and holding it and then reselling it. That's just too much. And now you're holding it. Therefore, it's like you're putting yourself through all the ups and downs versus, hey, you get in there, you're in there for 5 minutes, you're in there for 10 minutes, you're in there for an hour max or whatever the time is, you're out. So my recommendation, definitely options as opposed to you trying to trade the stock. It's just profit associated with it. It's just not much unless you like have hedge funds money that you're buying and selling with. And then people do that. They do that because they're trying to limit their risk because they have so much money. There's millions, and billions that's getting involved. Right. So I hope that answered everybody's questions. It is currently 9:25, 9:30. I've been on here for an hour and a half, guys. I think I am going to log off. Do you guys have any last questions before I log off? I hope I was able to help you guys. I was able to give you lots of info. All right. And then make sure for those that are on YouTube, right, make sure you click that link. I'm going to leave it in the description below. And then I'm also going to, yeah, I'll leave it below. And if you have any questions, and thoughts, just write it in the comments and I'll make sure to get back to you. And then don't forget to when you sign up, right, you can do a 7-day free trial. If you want to see it for yourself, you can do the monthly or you can do the yearly. You'll have the option to do either or, right? With that being said, guys, have a great rest of your evening. Thank you for your time. I appreciate you guys getting on here and wanting to better yourself and your education. I appreciate your time. And then I will see you guys the next time. All right. Have a great night, guys. And thank you. And don't forget to subscribe, guys, my YouTubers out there. Thank you. Have a good night, guys. Bye.